Ladies and gentlemen, welcome to another edition of In the Pit with Lobo Tiggre. Now we have a bit of an unusual show for you today in that usually I'm grilling some sort of mining company executive on how good or bad their project might be. And today is not that. Today we have an old school chum of mine. Well, I'm not really grilling, but he's a money manager in Europe and he has a different perspective from most of the people that I hear from on this side of the pond. My friend Egon is a managing partner of the Forum Finance Group of Geneva, Switzerland. So we've got questions for you, Egon, about how things are in the world and how they look from your side of the pond. But first, why don't you tell us a little bit about who you are and what you do there, and then we'll get to my questions.
Okay. Well, it's great to see you and speak to you again, Lobo, after, many years of doing so.
I don't want to say how many years.
No. We'll keep that quiet when we're at school together. Anyhow, we're a multi-family office based in Geneva. We manage about 1.7 billion dollars of clients' assets, and it's a global approach to investing. So we invest across all asset classes worldwide. Our clientele are also global families. Based, in Europe, Latin America, even Northern America, as we are also a registered investment advisor with the SEC out of Geneva, which is a bit unusual, and authorized by FINMA, which is the Swiss bank regulator. We've been around for this year we're celebrating 25 years of existence as a firm, and I think that's it in a nutshell.
Yes, very, very good. So before we dive into the world today, I just want to bring up that I talked to you some years ago, I guess about 10 years ago. We're coming out of the crisis of 2008, and you really surprised me because I never thought of you as, a gold bug or one of these crazy Americans, with their crazy ideas about the world and economy. And you had gotten your clients, or some of them anyway, into gold at the perfect time and came out really well. Through the volatility we saw there and the ensuing gold run up. So I wanted to mention this to our readers that if you sound like a mainstream money guy, you're not unwilling to think outside the box. But could you talk to us about that? Like, how did you identify that opportunity? What made you go there back then?
I guess it goes back a while, but I think talking to various analysts and looking at the supply and demand in the market, the physical market, it felt that gold was definitely at a point where it could be moving up again. And we were talking quite a lot to mining analysts, and perhaps that's one of the reasons why we spoke as well, because I was trying to get as much info as I could. Generally on that very specific, unusual sector. And it is very true that certainly across my clients and internally and externally, that most people we meet, we talk to, are either a gold bug or they hate it. And they never change their minds.
Very good. Yeah, they never change their minds.
It's a bit like in the UK, you'd say it's like Marmite. You either love it or you hate it. And which, by the way, Marmite is sort of rather unusual tasting spread people put on their bit of toast in the UK. Anyhow, so we really looked at the cost price of getting gold out of the ground. We looked at all those issues rather than just simply market momentum or what's going to happen if people get scared? Are they going to buy it simply as a safe haven or not? We do look at negative interest rates and things like that to see whether gold could be an interesting place as an alternative to park some of your money.
That's very interesting. So the natural follow-up question to that, of course, is how's it looking to you today? It's an interesting time in the markets. We've seen some renewed source of fear, after the long bull run on Wall Street. Are you bullish gold and precious metals today?
Yeah, so we got out of gold about 3-4 years ago for most of our clients, and because we just felt that the environment wasn't very conducive to gold, and it sort of traded, I guess, all the way down to nearly the cash cost of getting it out of the ground, which we reckon is closer to 1,100, as a general rule. it's a lot less if you don't account for various other costs. But so we sort of tend to take that as a yardstick, and now, funny enough, we've just published our investment perspectives for 2019, and not having had gold in our client portfolios for quite a number of years, we're now saying that gold make a comeback in client portfolios this year. So that's the first time we've written that for a number of years.
Fair enough. That's
Yeah.
about as forward-looking, I think, as I'm likely to get out of you. That's quite striking and interesting to me. I agree. Uh, so, okay, enough history. One of the main reasons why I wanted to get you on today is because you have such a different perspective. You have different news sources that surround you, different crowd that surrounds you than most of us here in North America, and you know that can create bubbles of perspective. So I'd like to run through a number of issues with you, if you will. And starting obviously with Brexit. That's the news of the day. Theresa May just suffered this horrific defeat, and it may have a no confidence vote, but never mind that. UK is one thing, but all of the EU is a much larger thing. How important is this? Like, if there's a no-deal Brexit, does that really upset the apple cart for all of Europe, or not? You know, how do you see this playing out, and what are the dangers?
It's really interesting. So I'm a Dutchman from the Netherlands by extraction, but married to a Brit. My wife's British. I lived there for many years. So I follow the BBC News on a daily basis, and been following the whole Brexit drama, quite frankly, unfolding, and for ever since they chose to have the referendum. At which time, by the way, we hedged our UK equity risk and our sterling risk, not because we thought the referendum was going to pass, as in Brexit would happen, but simply because of the risk reward at the time in the European equity markets, and in fact we hedged a lot of European equity risk at the time as well. So this is in June 16. And that was really because we didn't see much upside in the market, so we thought hedging it away wasn't much of an opportunity cost, but we saw quite a bit of downside if they did indeed vote in favor of Brexit, which we did not expect to happen. Anyway, as we now know, it did happen. The markets did correct sterling, everything. We took a few protections off quite soon, especially on the currency. So that worked very well at the time for us as a manager. We've been following it closely now, and for a year or so, the mess was clearly just getting messier. So we took UK exposure, sterling exposure, out of all our client portfolios about a year ago. So we're now looking at maybe putting it back on, but we're not doing that. We're still waiting. There's no obvious sort of upside, from a macro perspective. There are great UK companies with global businesses that trade at decent prices, like many other equities around the world. But as a total allocation, we're not looking at it. And it's because it's like rolling the dice at the moment. You just have no idea how it's going to turn out, and you keep thinking it can't possibly get worse, and then it does. In terms of the circumstances, you've had the Tories voting on having a vote of confidence on their leader. You've had now the House of Commons is having a confidence vote on the government, and none of these are expected to pass. Corbyn and most of my English friends in the UK, which are obviously the wealthier end of the spectrum, they're less worried about Brexit. They're more worried about Corbyn, the head of Labour, to actually come into government, because he would really put some very, very significant changes into place. I mean, nationalizations, huge tax rises. I mean, that would really be a very dramatic thing for the UK to happen. So Brexit itself is an unresolved issue, and there are many different options that I could talk about, but that would be wasting your time because we don't know which way it's going to go. And just to make my answer a little longer, because you asked about Europe and how we see Europe in all of this. So Europe is really not talking about it very much. The Spanish, French, German papers hardly ever really talk about it, whereas in the UK it's front page news every single day for 2 years. So the Europeans are sort of letting the EU Commissioner Juncker and Barnier, who are negotiating on behalf of the EU, 28 countries, 27 countries, just getting on with it. The one country that actually is expected to be hard hit by Brexit would be Holland, the Netherlands, because a lot of the traffic passes through the Netherlands. Because the Netherlands is a bit like the gateway to Europe. Rotterdam used to be the world's largest port. It's still a very large port. The boats. So that's where Holland is nervous, and they're making all sorts of preparations.
That's interesting. I thought you were going to say France. The channel and all.
Yeah. And Ireland, obviously, Ireland is also one of the countries that is expected to suffer because it's half EU, half British, with Northern Ireland being part of the UK. So that is the situation. Now it's clearly going to be bad news for everyone. In the same way that we haven't spoken about it yet, that any sort of trade tariff discussion Trump is having with many different parties in the world, it's just always short. In the short term, it's always bad news. Creates uncertainty, creates friction. It's just not what you want.
Okay, so unfair question maybe, but like worst case scenario, there's a messy no deal Brexit. Yes, it creates uncertainty, creates chaos. Things get topsy-turvy for a while. But could that really derail the EU recovery, or is it really just a sideshow? I mean, for all the headlines and hoopla, can the UK's...
It's a big market, the UK, so it will definitely have a negative impact. It's not, but I think the EU will just plod along as it does, as it always seems to do. And for any Anglo-Saxon type analyst or person looking at the EU, they're always puzzled as to how the EU is able to function at all. But I think it is simply a matter of years and years of people doing this. So they've got used to the red tape. They've got used to, or they know how to work around things. They've learned to work with the system, and that is often forgotten. Because if you just simply look at the circumstances as an outsider, you think how would it be impossible to function in that environment. But actually, they do all right. So it's Europe. The economic stats are clearly not good. I mean, they're getting they're coming down. The economic news generally we've had over the course of 2018 has not been great. So and that's after a reasonably good growth period prior to that. So it's sort of coming down to a more normalized level in my mind, rather than really going down into potentially even recession. But you'll see a few situations where it will dip below the zero line, but most economies are still growing at sort of around 1.5%, which for Europe is not so bad.
Right. In that context, sort of moving on with Europe as a theme here, do you think the ECB continues on its current path, or if things are seen to be slowing, does it maybe say, oh, well, maybe we need to be a little more supportive here?
Yeah, well, the great thing what the Fed's doing is clearly desperately trying to normalize interest rates, and is starting that process, and now also starting to even reduce the balance sheet. In Europe, it's completely different. Europe, the interest rates are still very low, negative. We have negative interest rates in Switzerland, 75 bips. In Europe, 25 bips. So. It's unprecedented. So nobody really knows how that story is going to end, quite frankly. But for now, for the foreseeable future, the ECB is unlikely to raise interest rates. I think it's very difficult for it to cut interest rates to stimulate the economy. So what it has started to do or announced it's going to do is to stop increasing its balance sheet. So that is a change, and that is something people are getting used to. But I don't see interest rates going up much, short term, long term. rates anytime soon. What we are seeing, and what is not talked about a lot, even here in Europe by strategists and analysts, etc., is that almost all countries in the EU are on some sort of fiscal stimulus program. So Germany, for instance, which is basically the largest economy in Europe, they're stimulating through their fiscal programs for the next 4 years about 1% of GDP a year. So that's it's not as significant what Trump did, but it's certainly very significant in the European context, and will at the very least be supportive of economic growth. And the same is happening in France, in Italy, possibly the UK. One of the few countries that stands out that isn't doing it is Spain. Europe really went for the austerity route rather than the stimulating the economy route. So this for Europe is, we think, is quite a significant change that is not really being fully appreciated by the market.
That's very interesting. So speaking of Italy and Spain and some of the enfants terribles of Europe, all this focus on the Brexit, may take our eye off the ball. There are other sources of potential trouble there. Is that perception of the so-called pigs, is that the past and actually everything is fine now, or more or less stable, or are people still worried about, Greece or Spain or Italy or any of these countries?
Yeah. As I said earlier, Brexit is a bit of almost a non. It's not talked about a lot. I think it should be, but it's not. It isn't. And if it because people just can't quite imagine a crashing out of the EU. Everyone is assuming there will be some deal, or some that will. Okay, there's gonna be friction. It's not going to be great. It's going to be awful for the UK. It's not going to be great for Europe. But people are actually focusing more on what's going on in Paris. These yellow vests protests in the streets. I mean, we haven't seen that for a very long time. That's quite serious, and it just keeps going. Personally, I was surprised that they hadn't come out sooner, because the new program and restructuring really of the economy that Macron was doing when he became president is I expected him to be in the street the next day, because it was quite significant what he's trying to do, and it's absolutely necessary what he's trying to do. So yeah, we're having a sort of Bastille Day type environment, quite a revolutionary environment in France, which is worrying. It is a small group of people, but they're very noisy. Italy, the clear disagreement between the EU and Italy as to how they need to stimulate their economy and to what extent they're able to do so by increasing their quite high debt pile even further, is something we're looking at very much and concerned about. Although most of the Italian debt is held by the Italians themselves, a bit like the sort of Japanese situation, and their actual deficits are not that far from other countries' deficits. They're still below the sort of rule that was set by the EU. It's more the size of the debt that seems to be the concern there. So yes, we are worrying about all these things, and Europe, there's always something to worry about. It's completely free of geopolitical issues. There are 28 countries, so there's always one or two or three, but there are the big ones now. So it is of great concern. Greece is small. Greece was always small, and Greece was always more about just not creating a problem for the banks that had lent Greece the money, and it was mostly German banks and a few others. So it was all about keeping, when the banks were just slowly starting to get their act together again, cleaning up their balance sheets and out of, coming out of that financial crisis, we really did not need a Greece to then sort of rip those balance sheets up again.
Right, right. So the overall view, the message I'm getting from you here is Europe muddles on somehow, as it always does.
Yes. Yeah,
Fair summary.
yeah,
Okay.
and it's always surprising, but it's sort of the situation. Um, and I think, as I said, growing at 1.5% or so is for Europe is really quite good.
Okay. All right. So hopping to the other side of the pond, how do Europeans view what's going on with the Fed? And you just said, they're trying to normalize. Do people see that as crazy, given, that we're still in uncharted waters after the collapse in
Um,
2008, or do they view that with envy? Wish we could do that. What's the European view of the U.S. central bank's actions?
Yeah, we think it's necessary. We feel we understand that it's a necessary evil. To push up interest rates, push up the cost of capital, um, because they need to get ready for the next showdown. So we totally understand the Fed's uh, motivation to normalize rates. We're also pleased that they're willing to take a breather when things are not as rosy as they might have thought. Um, we're still surprised to see very little wage inflation in the US, although there are clear pockets where it's very dramatic, I think. And we have to hear stories about truck drivers. Impossible to get a truck driver these days. So there's some very clear pockets of wage inflation, but inflation as a whole is not a big issue.
Is there much
So
concern that the Fed might be going too far too fast?
that's always a concern. Yeah, it's always a concern. But I don't think I'm just trying to remind myself what the situation is. I think the bond markets are indicating still two hikes. The probability is quite high, I think, in the bond market, but I may be wrong on this. So
Well, the outlook on Wall
help
Street
me out if
is
I'm wrong.
no,
But
no.
I think the Fed's indicating something different or talking different.
Well, they haven't actually changed their uh, projections. What's changed
Mm.
is their tone, and it's
Yeah,
the way that people pour through the tea leaves of the cups left behind by the various Federal Reserve bankers, to see what this word versus that word meant. It's kind of sad when you think about it.
mm.
But yes, the tone has definitely changed. And they say
Mm.
they're data dependent, so that means they actually don't have to say right now what they might change because it's data dependent,
Yeah,
right?
yeah,
But
yeah,
the perception right now on Wall Street certainly seems to be that the Fed has learned its lesson and there may be no rate hikes next year
yeah.
at all. So open question though, it really is, given all
It
the
is.
unprecedented things that you just talked about, is there really any way to do this safely? Can it even be done? Nobody knows. We've never been in this situation before.
Yeah. We were all expecting inflation to get really quite high and to wipe obviously away a lot of the debt out there. It just hasn't happened. So 10 years on, and we're still sitting on huge debt, and the debt pile is just getting bigger.
Yeah, it's quite striking. It hasn't happened in terms of consumer prices, but if you
Yeah,
look at it in terms of stock prices or maybe even Bitcoin prices, you could say there's
yeah,
been a lot of inflation.
yeah.
But anyway, okay, so the recent correction on Wall Street, we had
Hmm.
this record long bull run, and then you had this sort of panic set in during the fourth quarter of 2018.
Yeah.
Does that upset the view over there in Europe? How do people see that? More like, oh, it's just a blip in the road, or oh, those Yanks are finally going to get their due, or how's the view like over there?
Um, well, nobody enjoyed the which actually became a global correction. It wasn't just a U.S. correction, and Europe had been not been Europe has been almost sort of flat for 3-4 years. I mean, it's sort of up and down a bit, but it's hardly gone anywhere. Um, and the US obviously has, but also the US has enjoyed more economic growth. It's had a massive boost last year with the tax breaks. So you saw EPS growth, earnings growth for the S&P, I think, up 25% something. I mean, really amazing stuff. So I think anyone in Europe would be envious of that. Um, uh, you know, growing your economy by 1.5 and being pleased, so it just sort of tells you where we're coming from. But our sense is that we're not going to see a recession. We can't see it yet. We can't see a recession happening. Now, clearly, you can make a recession happening by just depressing everyone, and because then people start spending less. So some recessions can come out of negative, markets, but we still assume that generally speaking, a recession, a market is on the back of a recession rather than the other way around. A market move like that. So we're looking at it globally, and we think, generally speaking, the economic growth is still reasonably okay. It's definitely, the growth is decelerating quite a bit, but it's still going to be positive growth. The U.S. dollar talking about the dollar has I think has had a good run, and we sort of feel that vis-a-vis the basket, in particular the euro, that we could see that topping out a bit now. So we're not very long US dollars, but we do still like the US market, and particularly after the correction, because there are plenty of great companies. Having said that, we are more long-term investors rather than sort of traders, and as a result, we're more leaning towards value companies and fundamental factors. So,
so you're just let me jump in on that, Egon. Let me just jump in on that for clarity. You're not just buying the dip. You're not just saying, oh, the market's down, so it's a buying opportunity. You're saying the market is down, therefore some great companies will be legitimately undervalued, and that's what we want to look for. Is that?
Yes, and we actually we sat it out. We did not sell into the correction. We felt the correction was. Well, when it was happening, we thought it was just we didn't think it was going to keep going. Quite frankly, when it happened in October, we thought, okay, this is normal. This is an absolutely normal sort of move, of course, and it's quite healthy when you have these sort of corrections. But we were really quite shocked about what happened in December. I'll be honest with you, that was a very unexpected, huge move that dragged everything down. Growth, value. In fact, quite a bit of the growth value premium, I guess, sort of disappeared.
Or even the defensive stocks were down.
Yeah, but they were, yes, exactly. So it was an unusual period, and we've tried to analyze it with hindsight, because whilst it was happening, we couldn't make much head or tail of it, to be honest. So we're still reasonably bullish. We're still overweight equities, and we've stuck with our allocations throughout the correction. So it's been painful. But some Deutsche Bank research came out and demonstrated that 89% of all asset classes, and they'd sort of broken it down to 77 different asset classes. So they really looked at everything. 89% of those were down. That hasn't happened since the 1930s or something. So it's difficult for a wealth manager to get a proper, diversified portfolio that works. The diversification didn't work very well.
That's very interesting. Okay, so broadening then the outlook to what you are most keen on in 2019. You mentioned that for the first time in years, you've even included gold at all in that outlook. What else is in there? What are you willing to say? What else are you thinking is best sectors?
In fact, our website has all this on it, where we like to publicize our views. And
I'll give you that one. What's the URL?
ffgg.com.
Oh, very simple. ffgg.com. Okay.
Yeah, ffgg.com, and so in our news publication sort of tab, you'll find all our monthly newsletters and our investment perspectives, which is a bigger document published now in January, and then an update again in July. But so it's all there. So I'm happy to talk about it as well.
Give us the highlights.
So overweight equities, underweight fixed income, in particular investment grade, sovereign. We don't like any of that. We think yields will edge higher. so we don't want to have much duration. We like the more specialist bonds, loans, so the higher quality stuff amongst in the high yield space, so to speak. We don't think commodities are going to do particularly well. We think China and there's still a lot of reasons to global growth is not sort of booming. We think commodities are still a sort of challenging space. As I said, we do feel that gold is at the point, and definitely if it dips back to 1200, we'll be definitely buyers of bullion, and we're looking very closely again at the equities, because we used to invest in the mines themselves a lot as well, as you know. We like Japanese equities. We think the fundamentals are good in that market. It's not expensive. We're not big buyers of the Japanese economy, but we are of the Japanese companies. We also like emerging markets. We think emerging markets have really cleaned up their act over time and are more interesting now. So we like what areas that we wouldn't normally always like. EM, Japan, gold. And we think the US dollar is definitely sort of topping out. So we're not going very long US dollar for our non-US clients.
Okay. All right. That's fair enough. One thing you mentioned, and we kind of skipped over, and I don't want to wrap up this interview without touching on it, because it is a major issue in most investors' minds today, and that's the trade war. And even though the U.S. administration has really sort of taken shots at many partners around the world, the focus right now is very much on China. And I wonder how the European perspective, you're not the U.S., you're not China, you're seeing it from the outside. How does it look to you? Does this drag on? Is it just people, posturing, or is this something that both sides are serious about tackling? How does it look to you?
You're right. It's the $1 million question. It is what we think is going to move the markets into a more positive sentiment again. Whatever, Europe, okay, fine, muddles on, and whether or not they resolve their issues, a Brexit or not, that's not going to move the global sentiment, investor sentiment. America, China resolving their issues, that is going to really shift the market sentiment in our view. So that's what we're sort of waiting for this thing to resolve itself. Now, the Chinese, they can't afford to be too ballsy, because they have a slowing, an economy that is having slower growth. They are readjusting their economy. They're becoming more inward-looking rather than outward-looking. Want to rely more on their internal economy rather than always relying on their exports. So we think that the Chinese are going to want to work towards some reasonable outcome here. Now, I think Trump is he has his own way of dealing and negotiating, and it's entertaining. Sometimes shocking. I don't want to make any political statements, but I can sort of see where he's coming from. But I think it's not just about the simple trade tariffs that were put in place, decades ago, and are now no longer reasonable given the sort of very different weights of the parties involved. I get that, but it's actually, I think it's more about the theft of American IP, intellectual property. That's been going on for a while, and I think that is a serious concern. So I think those are the discussions that they're having, more than we might imagine, than just the sort of trade tariffs, or whether it's 5%, 20%, whatever, or no, or 0%. I think it's a lot about getting access to the local markets at all, and the Chinese no longer not paying much attention to global sets of rules, etc. So I think they're going to have to live up to, they're going to have to sort of do that. So I'm a little bit with the Americans, to be honest, on this. Yeah.
That's very interesting, and nobody has a crystal ball. So I always hate it when people say, "Well, what do you think is going to happen?" But I'm sensing from what you're saying is you think that both sides do want to see a resolution, or they want to see progress, and therefore we're likely to get some kind of positive news this year. You're bullish
Yeah.
on, if not a total resolution, then at least material progress in 2019. Is that fair?
Yes, that's certainly what we hope, and we one always has to rely on politicians to do the reasonable thing. Now they don't always do that for political reasons, but I think the economics make the economics would warrant some positive resolution. The politics, I think, also warrants a positive resolution. I think Trump needs some positive news. The Chinese don't need any positive political news.
For what it's worth, I quite agree.
Because nobody really gets a vote there.
I understand. No, so like I said, for what it's worth, my outlook on that is very similar. I do think both sides want to be able to go back and say they have good news. Maybe the average Chinese doesn't have much say in policy, but they do have an economic impact right now that is of concern to them. So I think both sides, it almost doesn't matter what the deal is or whether it's even materially much different. If both sides can say, yes, we've made progress and this is going to be better, they can go back home, they can say we won, and the world can get back to business.
Yeah.
Very good. Okay, well, it's been a good half hour of very interesting input from the other side of the pond. Any last comments you want to make sure that our viewers keep in mind?
No, well, just say that I enjoy reading your emails, and I'm going to talk to you when this is over about your platinum ideas, uranium, and I think those are really interesting areas to look at opportunities, because all this volatility has obviously thrown up enormous opportunities.
Yes, it's an interesting time. Okay, well, thank you very much for a fascinating conversation, and we'll talk soon.
All right. Take care.